All right, let's just jump right into it. We are looking at one of the absolute most fascinating structural shifts hitting the 2026 housing market, using digital wealth to buy physical real estate. We're basically watching a monumental collision between traditional banking and blockchain technology. A $4 trillion residential mortgage market is suddenly integrating digital assets, and, well, it's forcing us to completely rethink the very meaning of collateral. So we have to ask, is this the ultimate financial revolution, or are we literally just building a high-tech version of the subprime mortgage crisis?
Now you might be wondering, can you actually buy a home without selling your Bitcoin? For years, a very specific demographic has faced this incredibly frustrating dilemma. Being asset-rich in crypto often meant being cash-poor in fiat currency. You might have immense digital wealth, but traditional banks, they didn't care. They wanted fiat for a down payment. But now, we really have to ask if you can bridge that gap without liquidating. Can you finally unlock the front door of a new home while keeping your digital assets securely tucked away in your wallet?
The short answer? Yes, you absolutely can keep your coins. But, and this is a massive but, the velocity of crypto risk never sleeps. You're merging a super slow-moving physical asset, your home, with a digital asset that experiences on average 1.6% daily volatility. Think about that. If you don't fully understand the mechanics behind this, your dream home could quite literally be algorithmically liquidated in an afternoon.
So here is how we're going to systematically break down this explainer today. We'll start with the cash-poor, asset-rich dilemma, dive into token-backed collateralization mechanics, look at the tax alpha advantage, explore the brutal volatility buffer, analyze the one-chart liquidation risk, and finally ask, are we in the new subprime era?
Okay, Section 1. The cash-poor, asset-rich dilemma.
Look at this dynamic. An $80,000 Bitcoin floor has basically created a whole new class of really frustrated prospective buyers. We've got a generation that has watched home prices vastly outpace income growth, effectively locking them out of the traditional housing market. But at the same time, Bitcoin has consumed over 60% of the cryptocurrency market, and it has minted incredible wealth for younger investors. I mean, demographic data shows that 45% of younger investors own crypto, compared to just 18% of older cohorts. So they actually possess the required net worth for home ownership, but they still can't scrape together a 20% traditional fiat down payment without triggering massive penalties. They are, for all intents and purposes, locked out by the traditional W-2 box.
Let's move on to Section 2, token-backed collateralization mechanics. So how do we actually pull this off? How do we transform digital wealth into housing access? Well, it all comes down to complex collateralization. We aren't just sending Bitcoin directly to a home seller. Instead, we're building a standard conforming loan on the front end with a crypto-backed down payment loan quietly sitting right there in the back. This is known as a subordinate lien. Think of it as a secondary loan that takes the entire volatility hit so your primary mortgage doesn't have to. It completely isolates the extreme price swings of the crypto asset away from the primary traditional mortgage, which is what actually convinces these highly regulated banks to participate in the first place.
And here is exactly how the plumbing works. Take Better Home and Finance in early 2026, for example. They partnered with Coinbase to launch a product backed by Fannie Mae. Step 1. You pledge your Bitcoin or USDC to a highly secure custodian like Coinbase Prime. You do not sell it, you just lock it up. That pledge acts as the collateral for your secondary loan, which covers the cash down payment. Now, because that down payment is fully funded and handled, Step 3 is a breeze. You easily secure a primary, low-rate Fannie Mae mortgage on the house itself. You qualify based on your digital assets, completely bypassing those traditional banking gatekeepers.
Which brings us to Section 3, the tax alpha advantage. Now you might be asking, why jump through all these hoops? Why pledge your assets instead of just hitting the sell button, paying cash for the down payment, and keeping the whole shebang simple? Well, because the math heavily favors pledging. Under the latest IRS rules, cryptocurrency is treated as property. Let's say you liquidate $100,000 of Bitcoin. You immediately trigger a massive taxable event, often a 15 to 20% long-term capital gains tax, plus potentially a 3.8% net investment income tax. That is easily over 20 grand vanishing instantly just to make your down payment. Plus, you forfeit all future appreciation on that sold Bitcoin. On the flip side, collateralized borrowing is treated by the IRS as a non-taxable event. You preserve all your asset upside, and sure, while you might pay a slightly higher mortgage interest rate, maybe 0.5% to 1.5% higher, the tax savings alone almost always exceed the first 2 years of that mortgage interest combined. It's a real game changer.
All right, Section 4, the brutal volatility buffer.
Time to drop the hammer with the brutal truth here. Traditional real estate moves in months, while crypto moves in minutes. This is exactly where the theoretical elegance of these loans smashes right into the unforgiving reality of the market. To survive this extreme volatility, lenders are taking wildly different approaches to their loan-to-value, or LTV ratios. Take a look at this table. A lender like Milo allows you to finance up to 100% of the property, literally no cash down at all. But if your Bitcoin collateral drops by 65%, boom, you face a margin call. If you can't top up your account with more crypto or cash immediately, they liquidate. Conversely, the Better and Coinbase partnership takes a totally different route for their conforming loans. They eliminated margin calls based on price movement entirely. Your collateral is only at risk if you fail to make your actual mortgage payment for 60 days. Understanding these distinct liquidation triggers is absolutely crucial for any borrower.
Section 5. The one-chart liquidation risk.
So let's explore exactly what happens when those safety buffers fail, specifically for the platforms that do use price-based margin calls. This staggering number right here, negative 6.05 sigma, that represents the massive rate of change crash we saw back in February 2026. Bitcoin plunged from $90,000 all the way down to $60,000 so violently that it wiped out $3 to $4 billion in liquidations globally in a matter of hours.
And this brilliantly illustrates the true velocity of risk. Think about it. In traditional finance, if your home value drops or you miss a few payments, the foreclosure process takes months, sometimes even years. You have time to figure things out, right? But in the 24/7 crypto market, the timeline is absolutely ruthless. Within hours, a price plummet breaches your LTV threshold. Within minutes, if your auto top-up shield fails to cover the spread, you're exposed. And within seconds, automated programmatic smart contracts instantly seize and sell your collateral to protect the lender. Your wealth can literally be seized before you even finish your lunch.
I want you to really visualize this dynamic. Imagine a line charting your sinking Bitcoin value, and it is approaching the rigid, completely static bar of your 70% loan-to-value debt threshold. A standard 20% monthly drawdown in crypto, which, let's be honest, happens all the time, can push a high LTV loan right into the danger zone almost instantly.
The lines touch. You lose the house. That is it. That is the ultimate brutal truth for retail borrowers who fail to calculate their volatility buffer. If that sinking value line touches your dead threshold line, the math just takes over. You lose the house, or at the very least, you lose the collateral backing it at the absolute bottom of the market. Finally, Section 6, the new subprime era. Which brings us to the most critical macroeconomic question of all. Is 2008 happening all over again, just, on the blockchain? Are we repeating history with a fresh coat of digital paint? Well, the data actually points to a completely different structure. While 2008 was built on under-collateralized liar loans given to folks with zero assets and then hidden in incredibly opaque securities, the 2026 crypto mortgage market is the exact opposite. It is fundamentally defined by extreme over-collateralization. Borrowers often have to hold 150% to 200% of the loan value in digital assets. And rather than being hidden away, the secondary market notes and liquidations are entirely transparent on-chain. Structurally speaking, it's a much healthier foundation.
But just because it isn't 2008 doesn't mean there's zero risk. The real danger today is systemic fragility. Your home's collateral value is now intimately tied to global institutional risk appetites. If we see a massive ETF feedback loop where billions are suddenly drained out of spot Bitcoin ETFs, or if hedge funds simultaneously unwind their leverage bets, what we call basis trades, global liquidity can vanish in a heartbeat. Throw in derivatives markets that allow 100x leverage, and you get forced selling dynamics that can crash the price of your collateral in an instant, triggering those exact margin calls we just discussed.
So as we wrap up this explainer, I really want you to consider the duality of this new financial frontier. Bypassing traditional banking gatekeepers is an incredible achievement. It preserves your wealth, it avoids massive tax hits, and it honestly opens doors for a whole new generation of buyers. But you have to ask yourself, is this truly a financial revolution, or are we simply trading traditional credit risk for an unforgiving 24/7 liquidation engine? Ultimately, the answer entirely depends on how well you manage your own margin of safety.